What's going on, guys? Welcome back to another market warm-up. We have another busy week ahead, so we're going to get right into it. So 3 major call-outs for you this morning. The first one, we're going to hit on sector leadership, which we touched on a bit last week. But if we head over to our U.S. equities dashboard, you will see clear defensive leadership, and that is shown through XLV, XLU, so healthcare, utilities, along with consumer staples. And then REITs, which is XLRE, are not far behind. You can see them basically right on the line of our volatility trend level. Just to give you an idea of what utilities look like. Utilities are almost back to new highs. And then we have healthcare, which really hasn't had that big of a drawdown. And the reason that it's important to pay attention to this, as we mentioned, you don't want to just look at how much the S&P is up off the lows or how much it's up in the last month, right? Given this bear market rally, it's important to see where the money is going and what's actually leading the S&P higher. So these are not the sectors that investors are going to rush to buy in the next bull market, right? These are not sectors that will outperform during bull markets. These are actually what you want to be short generally in typical bull runs and moves higher, right? These are the safe havens that investors really only want to own when growth is slowing, where there's really nowhere else to go. So that's a big call out. Just wanted to hit on that to see where the money is going and what's driving this move higher. Now, the next one, we're going to bring it back to the yield curve, which just hit a new 52-week low today. It was down a little bit more to its low at negative 26 basis points, but it's now bounced up 2 basis points, so down at negative 24. I just want to show how this played out in reaction to the Fed meeting. So you can see right before we had the meeting, we had basically a new low at minus 25 basis points. As soon as the Fed came out and the Fed pivot started to become the new narrative, as in the Fed was going to not necessarily cut rates, but they weren't going to be as aggressive moving forward, the yield curve started to steepen, right? And then right after that, just 2 days later, now we are back at new cycle lows. So just looking at what the bond market is signaling, the probability of a recession is now moving back towards its highest point year to date. So we're back at new cycle lows for the yield curve. Watch how this unfolds, because there's a lot of things that can affect the equity market, right? We're just looking at positioning or shorter term catalysts. But the bond market tends to just follow the data and move based off rate of change. So pay attention to see how this unfolds over the next couple weeks. Now, the last major call out that I have for you guys, if you've been following me for a while, you've probably heard me talk about it before, but that is the implied volatility premiums or discounts across all of the major sectors in the market. So if we take a look at this chart from Longbow, you'll see the implied volatility landscape across all of those major sectors. So up at the top, when you have something to the right of that in the green, that shows that there is an implied volatility premium. And on the left side in the red, that is where you have your implied volatility discounts. Now, what does that mean? So the way you calculate this and get that premium or discount is by looking at the 30-day at the money put I-vol relative to the 30-day realized volatility. So when you have a premium, essentially what that shows is that investors are buying up protection, right? They're buying puts, they're expecting more volatility ahead, generally to the downside, because we're looking at the put volatility. So what we see here is that when investors are hedged, that essentially serves as a cushion for that sector. So this gives you a really good idea of how investors are positioning and how they're changing that positioning day to day based off the options implied vol. When you have a big implied volatility discount like you have here in the dollar or in the momentum basket, gold, XLP, I should also point out, other than I guess momentum, those are the clear defensive sectors. So if you are looking for defensive equities to own, these are definitely good spots to add when you do get those corrections. Now, when we have discounts, as we can see here on the left side and towards the bottom, you have these in SPYs, the Qs, semis, high beta, ARK, energy. That is when investors are getting complacent and they're actually covering shorts. It kind of just shows capitulation, right? They don't have any protection to the downside. So if we do see a quick flush, that is going to be perpetuated by the positioning because they don't have any protection. So investors are likely going to be forced to sell on the way down. They're going to have to be hedging as we move lower, which is going to increase that volume on the move down. So just to give you a simple takeaway, it's much harder to get a move lower when investors are already positioned for it. So that's what that premium shows you. That shows how they are actually buying puts and they are getting ready for a potential move lower. Now, it's much easier to get a move lower when nobody is positioned for it, right? So that's what these discounts are showing you. And the deeper those go into the red, the more probable a move lower is, as that capitulation just continues and nobody is ready for that move lower. So those are the 3 macro callouts that I had for you this morning. As you guys know, I am actively shorting this bounce. Last week, yeah, we were wrong for a couple days. It is what it is. But the best part about trading bear markets from the short side, that is that you can be wrong for couple weeks in a row and then be right for quite literally 2 days and be back in the green, right? So everybody knows, one of my favorite sayings out there is that risk happens slowly and then all at once, because that is 100% true. If you traded through, if you've really just been in the market for the past 6 months, then you know how how accurate that saying is. But, you know, we'll see how this week unfolds. I definitely still think the probabilities are weighted to the downside for a move lower. So that's how I'm positioning. And, you know, I'll let you know if anything changes there. And I just wanted to wrap up by saying that I'm now an official affiliate partner with MooMoo. And I wanted to show you guys the crazy deal that they have going on for the summer here. I'm sure you've heard about other referral programs in the past, you know, maybe with MooMoo, definitely with Webull or Robinhood. But here, if you just open an account with the link that I have in the description below, deposit $1, you'll receive 5 free stocks. And just as a little incentive, if you do open an account and send me a DM on Instagram, I will personally add you to our private investing group where you'll receive my daily updates, trade alerts, as well as all of these refreshed global macro dashboards that show all our volatility trends and ranges. You'll also receive our trading indicator completely free for the next month. So check out that link down in the description below. Send me a DM on Instagram once you have completed it. Literally takes like 5 minutes to set up, and it's a win-win for both of us. So thank you guys for watching, and I'll catch you guys back here tomorrow. Peace.